Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, Understanding Option Pricing, we'll take a look at the forces that generate your option prices and make them move in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, all of the previous OIC webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Understanding Option Pricing. Joe?
Hey, Nick, thanks so much, and thanks to everybody for joining us today. Yeah, today we're going to be talking about understanding option pricing. Honestly, I love talking about this stuff because you know, what's more important than the price of your options? I mean, maybe the price of your underlying, which of course does drive options, but you know, understanding option pricing really is the key to, I think, making more money with the listed options product. So for those of you who have been around the block a little bit, you know that we've got the characteristics and risks of standardized options document, which you can get from your broker or from us at the OIC or the OCC. You can also get it by calling our investor services desk at 888-OPTIONS if need be. For those of you, again, new to you know, the OIC events that we host, this is who we are. We are funded by the 12 option exchanges and the Options Clearing Corporation. We have been in existence since 1992, and we have one mission, and that is to get out, you know, on the street via live events, webinars, podcasts, what have you, to teach investors, both retail investors, financial advisors, even the institutional set, about the benefits and risks of the listed options product. Today, you know, I'll just speak very, you know, briefly about industry growth, and then we're just going to really get into the whole idea of option pricing, theoretical values, and of course, when you talk option pricing, you are talking the Greeks. Really, this is one of my favorite slides. It is a history of our still youthful industry that started in 1973 in Chicago. 16 underlyings, I think 920 some odd contracts traded that first day in April 1973, and now we're averaging somewhere in the neighborhood of 17 million contracts a day over the 12 exchanges. You can see the exponential growth starting in around 99-2000, when a couple real key changes in the industry with the advent of significant dual listing where all the exchanges listed each of the various underlyings and their options to drive the narrowing of option spreads through competition on the various exchanges. And then also at that same time, we had the formation of the ISE, the first electronic exchange, which gave all investors, professional and retail both, incredible efficient access to the marketplace. So let's get into our discussion about options pricing. Who makes option prices? Yeah, I'll tell you what, I could talk about that for days. And, you know, when we give presentations across the country, oftentimes I'll hear from investors, oh, well, I'm doing this, but I'm real nervous about the other side, and they're going to make all the money, or they know this, or they know that. Well, the fact is, market prices are made by all market participants. Obviously, that's the buy side and the sell side. You know, it may be the retail investor, it may be a financial advisor representing his investor, and it may be the big boys on Wall Street, you know, the institutional set. But both the liquidity and the access to the market through essentially electronics allows for efficient changing of those prices, you know, millisecond to millisecond. And so everybody's involved, retail, professional alike. And you know, when you talk about what's the options worth, well, the option is worth, and it's very obvious, but the option is worth exactly what the market is willing to pay. And obviously, option models can be used as guidelines for option prices, but those guidelines are driven by different factors that we're going to go through tonight, and those factors change, and that's what allows the dynamic movement of option prices. The pricing models, and there are a number of them, they go back to Black-Scholes in the early 70s, the binomial model in the late 70s, and of course there have been iterations of a number of them throughout the years. The pricing models are wonderful tools to allow us to have some basis for what drives option prices. But there are lots of factors out there that you know, drive option prices, and the core of what drives the price are the inputs to the options model. So, you know, very simply, 5 inputs. You've got your underlying stock price or index price. You've got your all-important strike price, volatility, timed expiration, and then the cost of money. That's going to be rates, you know, less any of the dividends. And, you know, you plug that into any one of your models, or you let the marketplace do that for you, and boom, out come, you know, the call and put theoretical values, better known as the Greeks. And the Greeks to me just are, you know, shouldn't be a difficult thing to grasp. I mean, a lot of people, you hear the Greeks and option pricing, they get turned off because, you know, they think it's beyond them. But, you know, let's simply take a look at, you know, these 5 Greeks and describe exactly what they are. Delta. Delta is the option price versus the changing stock price. Okay, and really why we talk about option pricing and the Greeks is because just like having a keen sense or forecast for any underlying that you're long or short, you want to have some sense for where your options are going, you know, when the underlying goes up or goes down. And it's these Greeks that help drive these theoretical models, which give us our option prices. So delta, again, is option price versus the changing underlying price. The gamma is a little bit different. That's a derivative of delta itself. So the option delta changes with the change in the underlying price. That's what the gamma is. The gamma is going to tell us how much the delta is going to change with a change in the underlying price. So not difficult. Basically, we'll go through a couple examples as well. Theta. For those of us who have been in the option space, we know theta. Theta is the amount of decay that these options basically erode by over the course of a day, a week. Those of us on the short side of options, just love theta as long as the underlying doesn't move too much. That's that ching, 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 ching in our account as we have the option decay, hopefully, falling into our account. Those on the long side, we certainly need the underlying to move in order to have the value of that option increase more than the amount of theta decrease. So theta is the option price versus the changing time until expiration. Vega. And Vega, is my favorite, Greek or input, if you will, because, Vega to me is, the Greek that really moves the most. I guess you could say that delta moves a lot too, but Vega just drives more of the premium in the option price than any of these other Greeks. And Vega is the option price versus changing volatility. And as we go on tonight, we'll talk about the two different types of volatility. Finally, Rho is interest rate, the interest rate component. So we're talking about the option price versus changing rates. And, in this really low interest rate environment, unless you go way out in time with your particular option, the interest rate component is not really going to impact your option price too dramatically. But, if rates were to rise fairly significantly, which is certainly unlikely, the Rho component or the Rho Greek might have more of an impact. It would have more of an impact. And, you can check that impact by trying our options calculator, our pricing calculator, which I'll talk about a little bit later too. So all of us who are in the option space, we've got our platform. You plug in your favorite underlying and boom, up comes all kinds of numbers. And a lot of those numbers I think investors just disregard, but a lot of them are awful important. And a screenshot like this hopefully duplicates a lot of what you see when you hit up your platforms. And the area that's highlighted the Greeks here, it's delta, gamma, theta, vega, and rho quantified. There really is some meaning behind these 7 decimal numbers that pop up on our screen every time we look. So let's go through exactly how these work. So delta, as we said, it's the expected change in the options price for a 1-point move in the underlying. So the expected change in the option price with a 1-point move in the underlying, that's delta. 3 types of options. You've got your in-the-money options, your at-the-money options, and your far out-of-the-money options. Now, delta, we talk about delta on a scale of 1 to 100 or 0 to 100. 100 delta option would be a deep-in-the-money option, and that'd be an option that would move point for point with the underlying. So if we're long a call and the underlying goes up $1, we would expect that deep in the money call to also go up by $1, essentially 100 delta. If we've got an at the money call, which is stay on the call side, and that underlying goes up by a point, all other Greeks and factors being equal, we would expect that at the money option to increase by 50 cents. So the numbers on your platforms correspond to money, essentially is how it works. And then the out-of-the-money calls can be anywhere, by definition, below 50 delta, so anywhere between 0 and 49. So if you've got a 45 delta option, you've got an option that's very close to the money. If you've got an option with a delta of 5, 10, 15, or 20, right off the bat that option's well out of the money, whether it's a call or a put. So again, delta, and if you're not familiar with this, do try to get it straight. Delta is the expected change in an options price when the stock goes up or down by $1. And of course, calls and puts will both have delta. So again, I said earlier, assuming all other factors remain constant, let's take 60 days to expiration. Let's take a volatility of, say, 28%, rates at 3%, no dividend. So we've got our stock at $50, and we've got an at-the-money call. The 50 call with the stock at 50, that would be the at-the-money, valued at $3. Over the course of the day, the stock goes from 50 to 51. So that 50 call, what do we think that call would appreciate to? Well, it's certainly going up because the stock went up. If you own a call and the stock goes up, the value of that call should go up. With a 50 delta, we would expect that $3 call to be worth, about $3.50 with the stock at 51. If the stock went from 51 to 52, you can figure that, okay, that call is now in the money by $1. The 50 call with the stock at 51 would be in the money by $1, so it would have $1 of intrinsic value. And if the stock went from 51 to 52, it's in the money a little bit, so maybe there's an extra 5 or 10 deltas on that 50 call. So rather than going up by 50 cents with the stock going from 51 to 52, how about if that call goes up maybe by 60 cents. So, maybe it had a 60 delta at 51 and a 50 delta at 50. So we get the 50-cent appreciation with the stock going from 50 to 51, and then an appreciation up to 410 with the stock going from 51 to 52. That's how delta works. I mean, if we had an out-of-the-money call with a 20 delta, and the stock went from 50 to 51, and the value of the call was, let's say, 3, we would expect that call to go to 320 rather than 350 if the delta was 50. Now, it's not exact. Again, the pricing models are guidelines. There are other factors that change all at the same time. Simple things like supply and demand impact option prices as well. But, they can all be worked into this whole idea of the Greeks. But that's the concept of delta. As the underlying moves, you can expect your option, call or put, to move by approximately the amount of the delta. Stock, we've got, we're going to go through this underlying actually quite a bit over the course of the presentation. So we've got our underlying price of 27 in our favorite XYZ stock. Strike price 25, so we're $2 in the money. Volatility 25%, rates at 1.5%, 90 days to expiration. Plug that into our pricing model, and what do we get? Bang. Theoretical value for the call and the put. The call is just under 260, 259 and change, and the put is just a fraction over 50 cents. The delta of the call is 76, and the delta of the put is, say, 24. So as the stock goes up a point, we would expect the value of that option to increase by 76 cents on the call side and decrease by 24 cents on the put side. That's how these Greeks can be so valuable. They can allow you to forecast. You first off start with your opinion of the underlying and maybe a forecast for where it's going, neutral, bullish to the upside, bearish to the downside, and then you pick, a favorite option or option spread or strategy and employ it around the forecast of that underlying, and then get into your pricing model and see what the pricing model, tells you the appreciation or loss in a particular option is going to be as that underlying moves. So again, just going the other way, and I mentioned it a little bit, if the stock were to fall, not go up by $1, well, that call is expected to decrease in value by 76 cents, but the put is going to increase in value because, puts should increase in value as the underlying drops. And theoretically, with, again, 28% implied, with the 25 strike in the stock at going from 27 to 26, you should see that put increase in value by about 24 cents. Again, it's a guideline. It's not typically going to be exact, but it's a great basis to allow you, to make different investment decisions. Now, this whole idea of call share equivalent, it's part of the reason, I like this presentation a lot is, call share equivalent, and this may not apply to all retail investors or even a lot of them, but, the way the folks on the floors and the professional traders, the way they trade options, they oftentimes will, hedge on a, per share equivalent basis. So, we're talking about the call being a 76 delta. If the underlying stock increased by $1, the 76 shares of stock obviously should increase by $76 to the upside. So the delta essentially indicates how much that stock should appreciate up or down. And that's on the call side. Same thing on the put side. If the underlying stock decreases by $1, like I said, you would expect that put to increase in value by 24 cents, but your hedge would be 24 shares of stock. If you were long a put, one of these 25 puts, which would be out of the money by $2 with a stock 27, to be quote unquote delta neutral based on the model's inputs, we'd be long 24 shares of stock and long one out of the money put. On the flip side, on the call side, that share equivalent, depending on whether we're long or short the call, if we're short the call, in order to, be theoretically hedged, we would be long 76 shares of the underlying and short the call. And so as the call goes up in value, as the stock goes up in value, the call will lose money, but that loss should be offset by the 76 shares of stock. And that's how really most professional traders, even, day retail traders, oftentimes they're using, that delta movement, which is generated through the gamma of the option, which we'll get into. They trade that stock back and forth for small increments to offset their decay over the course of the day. And the goal for people who do this full time is to make a heck of a lot more money day trading that underlying than is lost on the theta of the option over the course of a day. So, hedging delta is something that, lots of investors do. So, kind of to wrap up the delta discussion, deep in the money options have high deltas, high meaning, somewhere 80, 90, 100, close to 1, meaning the higher the delta, the more likely that option is to move close to point for point with the underlying as it moves up or down. At the money options, as I mentioned earlier, and we ran through that example, have a delta closer to 50. And then out of the money options, be it call or put, they're going to have a delta somewhere between 0 and 49. So calls have generally what's called positive delta, puts negative delta, because that negative delta means that essentially, if you're long puts, you're short stock, and that's where the whole idea of negative delta comes in. So that's delta. Let's take a look at Vega. Vega is really, as I said earlier, it's really my favorite Greek without question, because to me it is the key driver for option pricing. And when we talk option pricing, to me they're just two simple components. You've got the possibility of intrinsic value, which is the in-the-money amount, but all options, unless they're valued at 0, have time value. And that time value, whether it's a large premium or a small premium, is driven by implied volatility. And that Vega, if you will, is the market's forecast, as I'll mention again a little bit further in the presentation. It is the market's forecast for how much the underlying is expected to move going forward. So Vega itself, just like delta, is a quantifiable number, on your platform. Vega, the same thing, and Vega basically is the sensitivity of the option price to the change in implied volatility. That's what it is. And as the implied moves up, in our example, 1 point, both the call and puts move up by whatever that number is that is coming out of the model. Conversely, to the downside, if implieds drop by 1 or more percent, and that happens all the time, and that's why I love Vega so much, because depending on the underlying, Vega in all underlyings doesn't move a great deal, but in many of them it does. It moves a lot, and so you've got a combination of a forecast for the direction of the underlying, up, down, or sideways, but then also maybe just as important is that idea of how much the implied volatility is going to move also. Is that at a midpoint, extended to the upside, or maybe cheap to the downside? So Vega, just like Delta, is a number coming out of that theoretical model on your platform that tells you how much you can expect that option to increase or decrease as implied volatilities go up or down. So I've hinted a little bit at volatilities. Let's look at the two. Historic volatility, and honestly, it's important to get these two straight. Historic volatility, I like to refer to the underlying, its personality, how much it moves, to me, is the historic volatility. As the slide says, it's a statistic, it's a fact. There's nothing predictive about it. It is a specific statistic about how much the underlying has moved in the past over a certain measured period of time. That's historic volatility. Now, on the option side, and only options have implied volatility is representing the future. It is the market's expectation for how much that underlying will move going forward. And only options have implied volatility. Now, the great thing about implied volatility, or one of the cool things, is, sometimes that forecast of future movement is right, and other times it isn't. And for those of you, who use options, darn well. You take a look at those option implied vols in some of these underlyings where, earnings are coming out and the underlying has a history of really not being anywhere near exact about what maybe the revenues and the earnings are going to be. And what happens to those implied volatilities? Well, the market hates uncertainty, and for underlyings like that, that uncertainty is defined oftentimes by far higher implied volatilities, much greater time premium, not intrinsic value, but time premium. Often will expand really dramatically as we get into, something like earnings. You get into an underlying, with rumors. These are somewhat, well, earnings aren't extraordinary. Sometimes only the movement is extraordinary, but obviously, you get to look forward to that 4 times a year. Different things like unexpected corporate actions, as I said, rumors, things of that nature, they can come out of the blue and they can drive implied volatility, to the heights in the heavens, quicker than you can blink, and oftentimes you don't know what drove it. But, depending on your position, that can be a good thing or a bad thing. But to me, it's one of the really most interesting aspects of the marketplace, looking at things like implied volatility charts, which will come up in just a second. But getting back to the two types of volatilities, historic vol and implied vol, two very different, measures. Again, the historic volatility is just that. It's the history of how much the underlying has moved over a measured period of time, where implied is talking about the future. So you've got these two different measures. They can be somewhat similar. They can be, as the slide says, at great variance to one another. It really depends on so many different factors. But this whole idea of implied volatility, these implieds can change without the historic volatility level changing. As I said, rumors can drive it, just expectations for, corporate announcement. In a not too liquid underlying, a really big options order, can change the implied volatilities. A really big options order, especially when there's not all that much liquidity. So lots of different factors. I would urge you, if you're not in the habit, please, this next slide, slide 25, optionseducation.org, check out the implied volatility charts. This is, the implied versus historic volatility chart. We offer this on all the underlying ETFs and indexes. Basically, the blue is the historic volatility over the last year, and that goldish line, tan line, that's the implied vol line. I mean, to me, I don't, depending on whether you're a fundamentalist, a chartist, if you're a chartist, for your underlyings, I would think these implied historical vol charts, would be invaluable to you. You get to see different cycles over the course of a year. You get to see when the implied comes back down to the historic. If there's a tendency, for there to be a 3, 4, or 5 point premium of the implied over the historic, if there is a real cyclicality over the last year to implieds going up when earnings are about to be announced. That oftentimes, again, is driven by whether the company manages the street very well and whether earnings are typically right in line or they tend to surprise the street. So I would urge you, optionseducation.org, /quotes, or in our drop down under tools and resources, on the website, the home page, you'll find those quotes there, or these charts there. I would urge you, do use them for your favorite underlyings and get comfortable with the level of historic and implied volatility for your favorite underlyings. Different aspects of implied volatility. One is, you can see the right-hand column. We've got an implied of 43 and change, all the way down to 35% and change, and that runs, as you can see on the left side, strike price at 24 down to the out-of-the-money 27s. So that's how the marketplace works. There is a natural skew of implied volatility in the market typically, so the deep in the monies have a higher implied volatility. As you get further out of the money, the implied volatilities tend to drop. Part of that is driven by supply and demand. Oftentimes the out of the money puts, investors will pay more for. That drives the implieds of those deep in the money calls and out of the money puts to a higher implied level. So just, this whole idea of volatility skew is, one characteristic of most markets. And then also it's important just to realize not every month is created equal. As we've said, you can guess earnings months are going to have a premium in most situations where the implieds are going to be higher. Therefore, the time premium, and that's why, to me, the Vega component of the Greeks is the most important one, because it drives that time premium aspect. And after all, time premium is in every option that has value, and those that have intrinsic, it's time premium plus the intrinsic. So, having a sense for where those implieds are will give you a great opportunity to forecast where your option values may go. Let's take the same look at Vega on the call side. Same underlying, $27, strike price 25. The Vega is 25%, rates 1.5, and 90 days to expiration. Plug those components into your factors into your pricing model, and out come your theoretical values for the calls and puts. Vega in this instance is going to have a 4-cent value for the call and similar for the put. So as if the implied volatility went from 25 to 26%, the value of that call or put would increase if the implieds went up by 4 cents and decrease by 4 cents if the underlying went down. So let me just go back a little bit. So we're talking 4 cents in this particular example. Going back to these implied volatility charts, I mean, look at the tan line. I think we've got, lows in the mid-teens, highs in the low 20s. So it's a heck of a percentage, but that's, 5, 6, 7 point changes in implied volatility. If you, talk about that, well, let's just say a 5 point move to changing implied volatility from 25 to 30 times 4, you're going to get a bump of 20 cents in each one of those options. Everything, without maybe even the underlying changing. So, there can be really significant change, and that's just this one rather low volatility stock. Again, those of you who really spend a lot of time paying attention to volatility, you know darn well that implied volatilities can sometimes double and triple in the marketplace, as we've seen in the VIX recently with the added volatility in the market. The VIX was down in the low teens. Next thing you know, it's up into the high 20s. Well, that means that the time premium component of your options is going to, certainly double and darn near triple, just driven by these new implied volatility levels. So, to that point, if we went from 25 to 30% in the implieds, at 4 times, 5 times 4 would be 20. Initial value was 260. We have a 280 value in the call. And remember now, both calls and puts go up in value as the implieds change. Okay, a lot of people, they just figure it's going to be the call or the put. That's not the case. When we're talking implieds, as the implieds go up, the calls and puts go up, and if the implieds go down, the call and put go down, and that's all driven by the whole idea of put-call parity with the underlying in the marketplace. But, that's a conversation for another day, but that's what drives it. And here's, the flip side. If we went from 25 to 20% implied, we take 20 cents off that 260 call, take it down to 240, and the put would go from 50 cents to about 30 cents. But this happens all the time in the marketplace. Implied volatilities move. If you get into your pricing model and you have a very specific idea about implied volatility, you can plug it in and find out the value of your call or your put. And on an extreme side, if we go back to the 08, and actually, I was just talking about the VIX going from low to mid-teens to high 20s over the course of the last week and a half or so. If we go back to a more extreme period back in 08, 09, the VIX was also mid-teens. And then, we all know what happened back in 08, 09. It was actually November where the VIX topped out. The VIX went to 80. And so just as an extreme example here, if you've got your $27 stock and the strike price at 25 and nothing else changes except implied volatility, if it were to go to 75 and change, that $2.60 call would go to at least a $5 value. So that's the power of implied volatility. Again, on your platform, you can see the quantifiable value of Vega. I would urge you get comfortable with it. Go to your platform. More importantly, go to your pricing calculator and see how more important Vega becomes as you go further out in time. Okay? Short-dated options they certainly have a Vega component, but the further out you go in time, you'll see that the value of that Vega is far greater. So, check that out in your pricing calculator. Rules of thumb here: volatility measure price movements. It does not indicate direction. That's important. Okay, so volatility is about movement. It's not about direction. Obviously, and really it's just common sense, implied volatility usually greatest before news events. Before the event, the market's got uncertainty. The market doesn't like uncertainty. It pays a higher premium for uncertainty. After earnings or X announcement, oftentimes you'll find implied volatility is getting hit pretty hard. The higher the implied volatility, the higher the options price. The lower the implied volatility, the lower the options price. Again, that's the driver of that time premium component when it comes to the option price. Again, common sense, if you're long vol and vols go up, that's a good thing. If you've got falling vols, hopefully you're short options rather than long options, because decreasing vols are going to help shorts and hurt the longs. So that's Vega. Let's move over to Theta. And Theta, again, it's sellers try to collect, buyers try to have that underlying move more, so the value of that option will increase more than the amount of Theta if the stock's just sitting there and not allowing that option to increase in value at all. So Theta is the expected decrease in an option price for, any passage of time. Yeah, and that's one thing you need to be sure about, whether your Theta component on your model is based on a 1-day Theta value, whether it's a 7-day Theta value, just be aware of that. And, Theta is known as time decay. This is basically our typical chart of time decay, and you can see when we're out there 2-3 months out, sure, there's a loss of value, but not like there is when you get inside of 45 and 30 days. That's when the option premium really starts to drop off rather dramatically, and it's part of the reason why weekly options, of which there are close to 400 now, I think, on listed products, are so popular. Sellers only have to sweat for 7 days, and the buyers only have to pay 7 days worth of premium. So that whole accelerated idea of the Greeks has really driven a lot of volume into these short-dated options. Little pricing comparison, comparing an at-the-money call. So on a $50 stock, we're going to look at the $50 call. Let's look at the 3-month option versus the 2-year leap. So the 3-month option, we've got a value of $3.33. The 2-year option, we've got a value of just under $11. So after about a month, you can see that 3-month option, may lose somewhere in the neighborhood of 20% and, lose about 50-60 cents in value. The 2-year leap, on the other hand, we got 2 years left. It's going to lose maybe a little bit, but just a fraction, maybe 3%. 2 months into this 3-month dated option, we're figuring we're going to lose a solid third of our value at least. On the 3-month option, that thing's going to be down, below $2, but not exactly half its value. Well, I guess, let's see, 2 months in, meaning a month left, that option would have lost about half of its value. So rather, if we had a 3-month option halfway through, it would not have lost half its value. We really, need to lose about 2/3 of the time in order to lose half the value, and that just speaks to how Theta accelerates as we get closer to expiration. But again, 2 years out, whether we're 2 months, 3 months, it's going to be a pretty symmetrical loss of value on a Theta basis. But as you can see, that 3-month option, is just going to fall out of bed in the last month, and it's either going to be worth something intrinsically at expiration or it won't. If it's out of the money, that means it'll be worthless. But one thing I might add, so why wouldn't everybody just trade leaps if there's no Theta component, no Theta risk? Well, the reason for that is, as I mentioned earlier, let's, think about that Vega component. If the further out you go in time, the risk isn't so much Theta on the Greeks, it's the Vega. So, get to that pricing model, take a look at the Theta versus the Vega 2 years out in time, and then you'll see that's, leaps are a wonderful tool in a lot of different strategies, but it's, you can't trade them for free out there just because there is no Theta risk. Volatility, or the Vega, is the risk that comes into play with those leap options. So we'll go through that same idea with our $27 stock, $25 strike price, Vega at 25, 7-day Theta on the call going to be, almost 5 cents, and the put's going to be 4 cents. And this is, as the slide points out, this is over 7 days. So, be aware of whether your theta component is a daily or weekly number in your pricing model. Time decay is greatest as we get closer to the end of expiration, which we've mentioned a few times. Short-term option decay is greater than long-term option decay. That's exactly right. Further out in time, the risk, from a Greek standpoint is Vega, not Theta. Time decay hurts option holders or owners, and it can help option writers. Again, if a stock moves violently and you're short options, chances are, it's not going to be helping you at all. And then this last bullet's important, and just think about it in a broad contextual sense. Time decay is greatest for at-the-money options, less for in-the-money and out-of-the-monies. Well, why would that be? Why would time decay be greatest for at-the-money options? Well, the value in terms of time premium is the greatest for at-the-money options. In-the-money options, sure, they'll have time decay, but it's not going to be as great as the at-the-money options. And, of course, the out-of-the-money options are obviously going to have less than the at-the-money options. Theta comes out of the time premium part of the option price. It doesn't come out of the intrinsic value portion. So the optimal point for time value is at-the-money options. So that's why time decay is greatest for that type of option. Two more. And we'll go through these a little bit quicker. Gamma. Gamma, can freak people out a little bit. Well, gamma is, how much a delta moves. Well, who cares? Well, that's exactly what it is. Gamma is the anticipated change in the delta for a 1-point move in the underlying. And we'll just go through our $25 strike with the $27 stock, 25% implieds. Again, theoretical value, hopefully you recognize that, just under 260. The put at 50 cents. The delta at 76 for the call, 24 for the put. The gamma is 9. So the gamma, what does that mean then? Well, basically it means for the call, if the call goes up by $1, the delta of that 25 call will go from 76 to 85, getting to the point where it's closer to a point-for-point move with the underlying. And on the put side, if we've got a 9 gamma, that put is going to go either from a 24 to a 15 delta or the other way, depending on which way the stock moves. So again, it's based on a $1 move in the underlying, and that gamma is going to allow you to forecast how much the delta is expected to move, and then therefore the more the delta moves, the more the value of the option moves. And going back to our idea of delta and a equivalent underlying hedge, if the delta goes from 76 to 85 with the underlying moving by a point, if you are hedging that option delta, you would then have to trade an additional 9 shares of stock, buy or sell, depending on what your position was, to stay, quote unquote, delta neutral. But that's how it works, and that's how people who trade day in, day out frequently, that's often how they'll trade. They'll let the gamma, assuming the underlying is moving, the gamma will change the delta, and they will trade additional shares of stock up and down as the underlying moves. That's a big part of the game. So gamma basically is greatest when the stock is near the strike price. Okay, so these at-the-money options have potentially a lot of dynamic movement, especially as you get closer to expiration. Gamma is greatest when the stock is near the strike. As the stock moves away from the strike, it doesn't matter which direction, the gamma will decrease. And deep in the money options, as well as far out of the money options, don't have much gamma. And again, if you go to the pricing model, you can see how that works. Long options have positive gamma, so if you're long a call or long a straddle, you're going to gain delta as that underlying goes your way. So basically, if you're long gamma and the underlying goes up, you are going to get longer the underlying. The hope is that the amount of movement and the increase in the options offsets the amount of decay coming out of the theta in those long options. Short options, on the other hand, have negative gamma. So, you may be long the underlying, short some options, hoping to collect that theta day after day after day. But if that underlying, takes off up or down, let's say you're long the underlying, you're short at the money calls. If that underlying takes off, those deltas go from 50 to 60 to 70 to 80 and all the way up to 100. In order to stay, quote unquote, something close to delta neutral, you need to buy stock as that underlying goes up to stay delta neutral. But again, that's just how delta neutral traders do it. Our last Greek is rho, interest rates. As I said, in this climate, in a very low interest rate environment, very little impact on the shorter dated options from an interest rate component. Further out you go in time, plug in 3%, 4%, 5% on an option 18 months, 2 years, 2.5 years out in time, and see how just that rho or interest rate component can change the value of that option. Same example, your platform is going to have a quantifiable number depending on rates moving up or down that you can anticipate a change in the option value. So that's the Greeks. Just a couple more things. The pricing calculator, you will get those two right-hand columns, the delta gamma, the theta, vega, and rho. Get comfortable with those numbers. When you're both on your platform, and hopefully you will go to the OIC pricing calculator to allow you to become more comfortable on your platform. This whole idea of pricing models, they're theoretical in nature. A couple rules of thumb. Options will often be priced differently than the theoretical value. And that can be because the inputs that we've discussed, those Greeks, can change faster than maybe you change the inputs. As we said earlier, supply and demand can have an input. The bid-ask spreads can certainly change things. But there is, an example of our platform. And again, don't just have flexibility when it comes to theoretical value versus the bid-offer spread in the marketplace. If they are different, and that's often the case, and that's certainly the example in this slide, we've got a theoretical value of $7.04 on the call, and that bid-offer spread, for the call is 805 offered at 815. Well, the model says it's worth $7.04. How can it be worth 810 in the marketplace? Well, one of the Greeks has changed. Supply and demand has changed. That's how fluid and dynamic the markets are, and to me, that's why they can be so much fun to trade. Just kind of wrapping up. Yeah, of course, options do give us options. This happens to be one of my favorite slides, and you got 18 different positions there. I'm not suggesting you use 18 different option positions, but the important thing about this slide is those little yellow lines define risk and whether it's quantifiable or unlimited. Please do know the risk of all the different option type positions that you put on, whether they're just option positions or spreads by themselves or versus some underlyings. Here's a snapshot of our position simulator. It's a wonderful tool. You can put in single options, you can put in multi-leg strategies, you can put in underlying, change levels of implied volatility, change days to expiration, which here's an example of at expiration. Use it as a tool. It's free. All you need to do is spend a little time. So Nick, I think basically that'll wrap it up. Let's see. I think for those who are new, please, optionseducation.org is our site. We've got our fantastic investor services team at 888 Options 5 days a week. And you may speak a little bit to our relatively new mobile app, Nick. Take it away. Maybe we have a little time for questions.
Yeah, we do. We have a great mobile app on the iTunes store available for the iOS platform. Feel free to download that. Just search for Options Industry Council there, and you'll be able to learn option strategies on the go. Joe, we have just a few minutes left for questions. There was quite a bit of content today, but ladies and gentlemen, I do want to make sure that you understand if we're not able to get to your questions, you can reach out to our investor services team. Give them a call at 888 Options. They're here in our Chicago office, available during standard business hours. They're there to answer your options questions about strategies or concepts and should be able to help you out at any time. And Joe, we had a good number of very high-end investors today, some very good questions. So let's get right to it. One of the attendees wanted to know about how the underlying could possibly affect, or rather the option price could rather affect the underlying, because the underlying is a major factor in the price of an option. But is it ever possible that the option price could drive the underlying price if there's, say, a large purchase by an institution or something like that?
Well, the person who asked the question is exactly right. It's not the option prices themselves, but it's the option orders. And, in real liquid underlyings, and we know what those underlyings are, few individual option orders are going to drive that underlying. Okay, in our really, real liquid underlyings. But in the majority of underlyings, where, liquidity is good, but maybe not great, you better believe that a big put purchase order, call, for sale, calls to buy, whichever side it may be, you better believe that option order can drive that underlying in a big way on a couple fronts. I mean, basically, if a big order comes in and the crowd or, the electronic marketplace, let's say they take down 25 or 50,000 deltas, on a particular order, they've got to then turn around and hedge. And if there aren't, some calls that they can sell or puts that they can buy to offset that long 25,000 deltas, they got to go to the stock, and they're going to the stock anyway. Well, so immediately there's pressure, to sell that stock. And then the bottom line is if the stock runs away from the point at which they bought those options, well, guess what? You've got, 10, 15, 20, 25,000 shares of the underlying hanging over that market, and maybe, the thing keeps going down naturally, and the guy who took down all those deltas, was sucking wind, and that may force the price down even more. So, the answer is absolutely, Nick. In many circumstances, big option orders will drive the underlying price, maybe not all day, but maybe for, a not insignificant period of time.
That's great, Joe. It's always good to understand the marketplace from kind of a holistic 30,000-foot view. Joe, one of the concepts you've mentioned during the session quite a few times was the idea of being delta neutral. Can you talk a little bit about why it's good to be delta neutral?
Well, it may or may not be good to be delta neutral. I mean, some people would suggest, well, if you're delta neutral, how can you make any money? Well, the fact is, a lot of professional traders, they trade delta neutral, but they trade long and short Vega. Think of how many options are out there and how much we saw in our implied vol charts, how much implieds can move. So rather than trade delta, they trade Vega. So again, there are lots through the Greeks. There are different exposures in each Greek. And, one of the Greeks obviously is delta, and you can, just like the underlying, you can be long delta, short delta, or neutral delta. But chances are, if you're neutral delta, you got to figure out a different way to make money with one of the other Greeks.
Joe, is there any correlation between implied volatility, either regressing or progressing to the historical volatility, similar to the statistical concept of regression to the mean?
It's a great question. I don't know of any studies out there that basically support that idea. They may be out there. If they are, unfortunately, I don't know them. So, I go back to the charts, which is, it's a picture in my mind that I look to, more so than the math side. But I would urge that listener to, Google and see if he can come up with the fact that there are some studies that way. And honestly, Nick, if there are, maybe he could pass that on to Investor Services and then pass it on to us.
That'd be fantastic. We're always looking for people who know what they're talking about to call in and tell us some things about the marketplace as well. Joe, one last question as we're running out of time here in our 60-minute session. Is the Vega value in the pricing model derived from implied volatility?
Yeah, I mean, it is driven by all the components of these very complex models, but, the answer is essentially yes.
Joe, any final thoughts for our attendees today?
Nick, I just, as I said starting out, I mean, if you understand the Greeks, you're well on your way, in my mind, doing well in the option space. So if you don't understand them, do spend some time on our site, and I would urge you just to, be diligent, because understanding these things can be of great benefit.
Ladies and gentlemen, thank you for attending today. And as Joe mentioned, the position simulator on the options website is a fantastic resource for you to use. That's at optionseducation.org under the Tools and Resources dropdown. Again, today's session will be archived and will be accessible in a few hours from now using the same link you used to join us today. Additionally, all of our 2014 webinars are available on our YouTube channel. Just search for Options Industry Council, and you'll be able to review a number of options strategies and concepts at your own pace that way. And as Joe said, thank you so much for your time this afternoon. Since we were a little bit pressed for time at the end, we weren't able to get to all the questions we had. But as I said, please do call our Investor Services team, 888-OPTIONS. They're available during business hours to help answer your options questions. We'll be holding our next webinar on November 12th, when Kyle Graham of our Investor Services team here at OIC will present on the topic of backspreads. Make sure to check our website at optionseducation.org or keep an eye on your email in the upcoming weeks for details. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.